We're up to Appendix C, and this is the video on the basics. So first of all, what are we talking about in Appendix C? Well, we're talking about investments, and basically two different kinds: debt investments and equity investments. Your debt investments are when the company invests in the bonds of another company. So bonds and stocks trade on the open market. So now our company is buying the bonds that another company has issued. Equity investments, these are stock investments in the stock of other companies. So this gets a little bit confusing because there'll be different types of, basically your equity investments are, that's investments in stock. We'll use the term equity to describe two different types of stock investments. We have the equity method and the fair value method, but we'll get to that later. For now, I'm going to be talking about debt investments, investments in bonds, equity investments, investments in stock. Okay, so why do companies invest? Basically for good cash management. That can be one reason. They've got a little bit of extra cash. It doesn't make sense to have it sitting in a non-interest bearing account when you could invest it in a fairly safe investment that might be paying a 3 or 4 or 5% dividend. So managing excess cash would be one reason. For longer term, earning a regular income. Your debt investments will be paying interest revenue. They'll be paying interest revenue to the company, generally twice a year. And stock investments will be paying dividend revenue. So if you buy stock, you might get quarterly dividend payments. So if a company has excess cash over the long term, they could count some of those dividend and interest revenue as part of their regular ongoing cash that's coming in. And then there's the old buy low and sell high thing, capital gains. You buy the stock when its price is low, you sell it as it gets higher, and you make some gains on the transactions. You have to keep in mind losses are also quite possible. And then there's the strategic reasons. And remember, we're talking about why companies invest here. Strategic reasons: one company buys stock in another company, so maybe they can exert some influence over that company. So in this case, maybe they're buying enough of the stock so that when they call up that company with, a question or a suggestion, they actually get a call back. If I own, 10 shares of, Microsoft, and I call them up and say, oh, I have a suggestion, they're not going to talk to me. But if someone owns, 1 million shares, well, they just might. So strategic reasons, a lot of the pharmaceutical companies will buy smaller pharmaceutical companies that are developing new drugs just to sort of keep those drugs in their pipeline. You have Coca-Cola company owns a good portion of Coca-Cola bottling, so if there's a shortage of bottles, they're going to get them first. So there's all kinds of strategic reasons for buying, a lot of the stock of another company. Okay, so then you get a situation, I don't have it down here, but when a company buys like 51 or more than 50% of the company, they would actually control that company, and that's, I guess, that could be a subcategory of your strategic reasons. Okay, so when it comes to accounting for all of these things, the accounting at a fundamental level is supposed to reflect the economic reality. So in all of these whys, we've got a whole bunch of different economic realities that we have to account for. So we're going to have all of these different categories we have to learn how to work with. So we've got debt investments trading. This would be the economic reality where we're going to be selling these investments fairly soon. Maybe we're just have invested the cash for the short term to get a little bit of income coming in. We're going to have debt investments available for sale. Those can be short or long term. They're basically debt investments we might sell sometime. And then we've got debt investments that we're planning to hold until their due date. Now, debt investments have a due date. Remember, we have a 10-year bond or a 5-year bond. That's a maturity date. And so if we're buying this debt investment with the purpose of holding it until it comes due, We're going to classify that as debt investments held to maturity. Then we get to our stock investments. And so we're going to have the equity investments of under 20%. And here we're going to use what's called the fair value method to account for this. These, we don't have any real control over the company. We don't own enough stock, so they're going to call us back. So we've got equity investments under 20%. We're going to use the fair value method. Then we've got the equity investments that we may have bought these companies for strategic reasons. We have some influence over their operations. And so for that, we're going to use what's called the equity method, which is where things get a little bit confusing because these are both equity investments. We're using the equity method here, the fair value method here, but you know. Okay, and then we get equity investments of 50% plus. And for those, we don't have to worry about any journal entries because those we would be doing consolidated financial statements. Okay, and we don't cover that in this course, but you have to know that if one company buys more than 50% of the stock of another company, they control that company, and we're going to just file consolidated financial statements. Okay, one thing that your text does not cover are transaction costs, and I just want you to be aware, please look at the notes that go along with this video, and it gives some explanation of them. Older texts have included transaction costs when they're doing the buying and selling of both debt and equity investments. Why you need to know that for personal reasons is that if you don't account for transaction costs, you're probably going to be paying more tax than you need to on these transactions. But as I say, transaction costs are not going to be on any of the exams for this course, but it would be a good idea to know about them. Okay, so that's covers Appendix C, the basics, and then we'll get on to the accounting.